Welcome, viewers, for another episode of Wealth Wednesdays. We are glad to have you back. Today, we are talking about collective investment schemes. So tune in to learn more about how you can start your investment journey using the money market funds. You've talked about diversification, just putting your money in different pots. So if I'm an investor who's tried fixed deposits, I've tried SACCOs, and I want to take a little bit more risk, but historia bonds, I really don't know it. So is there anything maybe within the collective space
that you can buy? Sure, you can. I know bonds have become a bit more of a conversation in the Kenyan context now. And yes, there is in the unit trust services or unit trust funds, we do have unit trusts that are actually investing primarily in bonds, and they are called bond funds or fixed income funds. So if you invest in those ones, you actually get the exposure to the bond market, just as going to the central bank or going to a broker and buying the bond yourself. So instead, you buy the bond fund and the manager invests primarily in bonds, and so you get the same benefits as the bonds that are in the market. So they're there, and you don't need a lot of capital outlay. You start with very low minimums, like 1,000, and then you can keep adding and building. Yes.
So, but what is the primary difference between that and me going directly to central bank or through a bank or a broker?
Yeah, wonderful question. So when you come through a manager, I think one of the fundamental things you'll appreciate is that you are getting professional services at a small fee. So you get the best brains actually working for you. So you're hiring a manager. Imagine 1,000 shillings hiring a manager.
So that's someone amazing. Working for you while you sleep.
Yes, while you sleep. So somebody actually thinks. When you decide to go directly, it means you need to have the knowledge and the capability to select the right instruments. So you must arm yourself with knowledge and the time to do the transactions every now and then, because it does require a form of transactions that you'll need to complete at any one particular time, and also research that goes hand in hand with investing. Do not ever assume that investments are made without doing research. It requires a lot of research before making an investment decision. Then that's what your manager does. They do all the research work, then they make the investment decision. So if you go it alone, it will mean I'd expect that you're doing research before you invest. You have the time to carry out the transactions and make sure you don't bounce some of these transactions, especially with the central bank. We don't play around. If it is time to pay, you must pay and don't start stories. Then you must have the minimums, which are usually a little higher than in a unit trust. So like, for example, if you're going directly to buy a bond, you will need a minimum of 50,000, which in a unit trust, we only need maybe 1,000 shillings. And that kind of stress that comes with doing it yourself. But definitely build your knowledge and maybe get an investment advisor who can walk the journey with you and buy you those bonds and the instruments that you're looking for.
Okay. Yeah. And just so now maybe someone has had this and they're like, okay, fine, I think I should put my money there. Where do they go? Where do you get these unit trusts?
So unit trusts are largely offered by fund managers, and we are licensed by the Capital Markets Authority. So you find on the website of the Capital Markets Authority, they have listed all the available fund managers in Kenya. So it's a lot of work for you to screen and say, these are the different managers. But yes, you will find the names there, and you can start there by just saying, this is the available list of managers who have these unit trust products. But I'll speak as ABSA because I'm here and say, start with ABSA, walk to any of the branches and just ask, I want to buy a unit trust product, and we're going to walk you the journey of buying and investing.
Okay. Yeah. And so once you walk in and you say, yes, I want a unit trust. And you've mentioned it works like a chama.
Yes.
So are there meetings where we are told how it's performing
Oh.
or how do you get information?
Very good.
Yeah.
Meetings, yes. So this group of people who have come together and they invest together.
Yeah.
We do call them for meetings. There is at least one annual general meeting for the unit holders, for the investors.
Yeah.
And that is mandatory by the Capital Markets Authority, that we meet and report on how the fund is performing and how the monies are invested, and you're able to see the statements of accounts, just like you see the big companies publishing their results. We do publish the results of the unit trust funds. Other than that, on a monthly basis, we give you a statement of account which shows you how your fund is performing. So you're able to track how you've been placing your money and what incomes you have been making.
Yeah.
And on top of that, on a monthly basis, we give you a fact sheet. A fact sheet gives you an analysis of how the fund has performed every month and where it is headed, so you can be able to track your investment. And now that we have gone digital, we also have a lot of digital platforms that are giving us this information. So information is available across, and do not be afraid as an investor to ask questions. Call back, ask those questions like, what's happening in the investment world? What is changing? What should I be afraid of? What should I be looking out for as a risk or as an opportunity? And we'll be able to share with you even extra information, because we are approachable. And I believe we are not in places where not approachable. Come to the offices, call us, and engage the managers and just get to know more about your investment.
So in short, don't be lazy.
Oh,
you
yes.
cannot be a lazy investor.
No, you can't. No, you can't.
Go to the Capital Markets website, find the company you want to, go with, and start the investment journey.
Yes.
Just don't be lazy.
Absolutely.
Okay. So now, when we come for these meetings, you also mentioned that interest is distributed at the end of the month.
Yes.
On what basis?
The interest that you are talking about distribution, remember we came with different sizes. Your size this, size this, size this. Yeah. And by size, I mean one person may have brought 1 million, another one may have started with 1,000, another one 20,000. So what happens is that the manager makes interest from all this whole pot.
Yes.
And distributes to each one of you according to your size. So there's fairness. The person who came with 1 million and the person who came with 1,000, if I'm distributing at 10%, I will distribute 10% of 1,000 and 10% of 1 million. So everybody gets a fair share of their interest. Nobody gets to be disadvantaged. And that's another beauty of unit trust, that they actually...
There's no discrimination.
There's no discrimination. It's so fair. And in fact, the smaller investors get to enjoy the ride with the big guys.
Yeah.
What else would you be looking for? It's amazing.
It makes a lot of sense.
Yeah.
And of course, when you talk about returns, we must also talk about the cost.
Sure.
Is there a cost to this?
Oh, yes. I said when you come to invest in unit trust, you definitely are buying the services of a fund manager, a professional. And so we charge a fee. So all unit trusts, we charge a fee for running these funds, for making sure that you're getting your returns and you're investing properly. So there is a fund management fee. And of course, if you read a little more, you'll find that the assets that we have bought, they are held by a bank, a custodian bank. They don't hold it for us for free. They charge a fee also, a small fee. But these fees are distributed across all the unit holders. So if you're like, say, 1 million unit holders in a fund, we will distribute that cost to all of you and distribute income minus the cost of running the fund. So it's just like a company. So there's a cost of running the company, then you distribute the dividend. You get the point? So companies make income, the less the expenses of running the company, then distribute a dividend. That's how a fund works.
That's how it works.
Yes.
So, but will I feel the cost at the point of withdrawal? Will I come and I'm told, okay, so this is your 1,000, give us back 50 bob?
Like companies make losses.
Yeah.
Like money market funds specifically, the manager will work very hard that the incomes will always be higher than the expenses so that we preserve. Remember, the key word we talked about is preservation.
Yes.
So we'll work very hard. But I don't want to leave here without disclosing that for funds which are not money market, like equity fund, balance fund, bond funds, and that kind of thing, it is possible that the investment income won't may in some years be less than the expenses. Reason being, when you invest in other instruments like shares, so an equity fund invests in shares, it is possible you can face a year like 2022 where we saw shares drop from highs of 50s and go all the way to 30s.
Yes.
So that means the value of the fund has significantly come down compared even to the expenses. The drop, like the market last year, the market was down 23%. Now, that alone has wiped value from the investments that are in equity funds. So if you just do that, even before you remove the fund manager's fees and things like that, you will find that your investment may actually have come down. So if you had started with 1,000 and the only share we had invested was Safaricom, and Safaricom is down 33%, you can see
So
you may come and we give you a statement reading 900 shillings. Isn't it?
Yes.
And that has everything to do with markets. And that's why we talk about funds which are not money market. They do have risk that your valuation and your value of investment may go below the price you came in.
Okay.
Yeah.
So if you're not a risk taker,
Yeah.
your safest bet is a money market fund.
If not only a risk taker, if you're starting to learn about investments, start by dipping your toes, not the whole, don't immerse your body.
True.
Dip your toes in money market, where at least you will get positive, I wanted to say positive vibes about the
It
interest.
is positive
It's
vibes.
positive vibes because you always get a positive return.
Yeah.
Because sometimes if you dip yourself into, say, equity funds because you've been told shares can also go up 60%, you know that is true.
It is
Then
true.
the year you come, they go down minus 30.
Yes.
You can see the disappointment that investor would start with,
Yeah.
and they would hate investing. So I always tell them, if you're starting, start with what gives you positive energy and helps you to appreciate investments, then gradually transition to other types of investments as you become more knowledgeable. So that's my advice to a layman who's just starting.
So if you're already in equity fund or balanced fund and you see this dip, is that the time to run? You know, as Kenyans, we like, you see danger, run.
Run. Yes. After you have invested, again, you don't remain lazy.
Yeah.
You've got to manage that portfolio together with your investment advisor, and you can switch. If the outlook, because we give managers, we tend to give the outlook of markets, what we expect will pan out in the capital markets every year and every now and then. It is possible for you to shift your portfolio, say from bond fund to money market when markets are looking risky, or from shares to money market when the markets look risky. So you don't have to stay in just for the sake of staying in. You can switch your portfolio and reduce your risk. So a lot of times you reduce your risk or even take extra risk. For example, if you're seeing a bull run, move from money market and now move to equities which are looking, they will start going up. But that is subject to very good research. Again, appropriate the research by your manager so that as you're making that decision, you're making a decision informed by strong research, not just maybe this year we are going to make something, let me move. No. Don't do that. Don't speculate. Don't speculate. Come talk to us. We'll give you that information.
Okay.
Yeah.
So for the people who wait until, you know, when the equity fund starts going up, then it's reached almost the peak and you're like, hey, it's doing too well, I need to jump in. What advice would you give them?
It's so hard to, okay, I'll tell you something about stock markets. stock markets, first of all, it's difficult to time the market.
Yeah.
You know, because there are also those ones who wait for the bottom.
Exactly.
And as they wait, the market starts creeping
going up.
Okay. Or you wait for it to, you say, let me see whether this actually is going up or so you never time market. So we say it's not about timing the market, it's about the time in the market. Because for stock markets, I advise people to come and invest if they have a long-term mindset, not short-term. Because when you have short-term, you will come, probably buy, say, this share at price X, then it goes up maybe 2 shillings, it looks good, another 2 shillings. Then for some reason, something comes and the share price comes down, and if you panic, you sell, you lose. But if you just ride out, it just means markets keep on doing this.
Yeah.
So as they do this, you need to observe whether they are doing this as they go up, because they're going down and up, but the trend is upwards.
Yes.
So understanding the market dynamics is very important. That's where your manager comes in. We can tell you whether the trends are going downwards or the trends are going upwards, and therefore make a better decision call whether to exit or to buy in. But when you're investing, when you're starting, come with a mindset of long-term investing. And long-term, I will say, at least through a 5-year cycle. 5-year cycle is what we say in economics. An economy has gone through a rough patch, recovered, and now it is booming.
So you keep mentioning, talk to your fund manager. Your fund manager should tell you.
Yes.
So you mean to tell me, as a Kenyan,
Yes.
with my 1,000 or 5,000 shillings, I have a right to walk in and demand for, I need an explanation. How is the market? Tell
Yes,
me
you
more
do.
about Safaricom.
Yes, you do have that right to come and talk to your manager.
Yeah.
Yes. Don't be afraid. Many Kenyans don't come to us. We hardly ever see them coming to talk to us.
Yeah.
But they'll talk to their friends and then invest based on what this group was saying, what they saw posted and things like that. Just come and talk
yet
to
they
us.
left the expert.
Yes,
And yet you're paying them.
Yes, and that is what the rich do, and what we don't do. The rich always consult.
Yeah.
The people who are starting to build their wealth, they hardly ever consult. Please come and consult. You will don't be afraid that you're starting low. It's a journey. It is not a destination.
Yeah.
It's a journey.
So that's it for today. We are looking forward to host you next Wednesday for another episode of Wealth Wednesdays. Remember to like, share, subscribe, engage with us on all our social media platforms. We are on Instagram, Twitter, Facebook, and even here on YouTube. We want to hear from you. What do you want to learn from us? What do you want to hear from us? What questions do you have when it comes to investments? Who do you want to see on the channel? Give us your suggestions and we'll make sure it happens. Thank you.